Shares of Cogeco are trading today 3.5% higher after the company reported profit that did exceed expectations. Our next guest says the company continues to trade at a large discount to both Canadian and American peers. Let's go to Vince Valentini, Managing Director, Equity Research, TD Cowen. Thanks for joining us today.
Thanks for having me.
So, Vince, numbers are down year over year, but still considered a beat. So can you give us a wider look as to what has been dragging this company down?
Sure thing. Yeah, the expectations were pretty low, so the beat was off a low base. They've been having some real troubles in their U.S. cable segment. The main portion of this business is their core Canadian business, which they've been running for 40 years. But over the last decade, they've expanded into the U.S. cable market, and that market has gotten really competitive in the last 2 or 3 years. Fixed wireless competitors like T-Mobile, new people building fiber to compete with cable companies. So they have been losing internet subscribers at a pretty rapid pace over the past 5 or 6 quarters. And that had scared people, and that's flowing through their revenue and EBITDA that we're still seeing them report today. But the shining light today was their internet subscribers in the US market were down much less than people expected, only down 1,000, where most people were expecting 6,000 or 7,000 losses. That's the best quarter they've put up in 15 quarters in that U.S. business. So some signs of stabilization, better marketing execution by the Cogeco team in that challenged U.S. market. But the key thing that's driving the financials is still their Canadian business.
Okay, so have they focused more on Breezeline, I guess is their brand in the U.S. Have they been focused more on American operations and trying to steady that?
Yes, absolutely. The new CEO came in just over 2 years ago. He's in the midst of a 3-year action plan to address the cost side of the equation. If they don't have much revenue growth in the U.S., they want to make sure the cost structure is aligned with that, so the cash flow generation is still strong, and also has rejuvenated some of their marketing strategies. He's using new digital sales tactics. They're launching a new digital brand in February in the U.S. market, similar to the Oxio digital brand that they would have in Canada. That's been quite successful, and just better sort of call center and marketing activities using data analytics and new technology to the best extent they can to try to make sure they get at least their fair share of the internet subscribers in a competitive market. And this quarter is the first time we've seen some good evidence that those efforts are gaining traction.
Is Cogeco seeing any growth in Canada?
Yeah, absolutely. They've actually been the best performing Canadian cable company. If you just look at core sort of subscriber metrics, their internet subscribers are up 5% over the last 12 months in Canada, which is a combination of doing okay in their legacy core territories like Oakville and Burlington, but also they've expanded into rural areas with government subsidy help, and they're having a lot of success growing subscribers there. Plus that Oxio digital brand that I mentioned before that gives them a two-pronged attack in the market. Cogeco and Oxio are sort of different brands with different price points. So yeah, no, in Canada they're seeing decent internet subscriber growth. Their EBITDA, I mean, this is not a fast growth business. No telco is putting up huge amounts of growth. People don't own telcos or cable companies for growth. They own them for cash flow and dividends and defense. But still, they put up 2% EBITDA growth year over year in their Canadian business this quarter, which people view as quite respectable.
Okay, you're thinking that they're going to have about $200 million in share buybacks this year. Why is that?
Yeah, so this is the key as to why I still like this stock, and we took our target price up to $100 today, is I think people are missing that even though there's not much growth here, the valuation is at rock bottom levels. This is one of the 5 highest free cash flow yielding names in the entire TSX, not just the telecom sector, which means it's one of the 5 cheapest names on a free cash flow basis. When you're generating that much free cash flow, which is very stable and predictable, people need their internet connections, and there may be a little bit of negative growth, but for the most part, their business is stable. They can use that cash flow as a weapon almost when their share price is this cheap. The free cash flow yield up near 20% means they can be very accretive and opportunistic in buying back shares. They've just come through a period of paying down debt. They got both S&P and Moody's to improve their credit ratings over the past couple of months, which I think will free them up to start buying back shares, which they haven't done for a couple of years. Management seems to be signaling they won't start this next week or next month, but I think as we move into the next fiscal year that starts in September, we'll start to see them buy back shares. And if they can buy back 200 million shares, that's a material buyback that is going to be materially accretive to EPS and free cash flow per share that I don't think the market has priced that into the stock yet.
I was going to say, why do you think Cogeco gets overlooked if it is in that situation where it's going to buy back and, as you say, the valuation is quite low?
It gets overlooked for two reasons. One, it's just smaller and doesn't have all of the asset classes that we think of a traditional telco, most notably wireless. So the big guys like Bell and TELUS and Rogers are all integrated fixed line and wireless players, much bigger market caps, much more liquid names. So Cogeco is a little bit of an afterthought from a business and scale perspective. There's also a bit of a taint on the name, to be quite honest, of historic actions that the board and sort of ownership have taken. If you recall back in 2020, takeover offer from Rogers and Altice at $150 a share. The stock price is now sitting around 70, and some people have long memories to say, hey, if you weren't willing to consider shareholder-friendly alternatives like that takeover offer at that time, we're a little bit gun shy to come back to the name. So there's two kind of reasons it's in the penalty box, but I acknowledge those headwinds, but I still think the stock is too inexpensive now and has good room to rally.
And it does pay a decent dividend, 5.5%.
Look, I think that gets very overlooked. The stock has a higher dividend yield than BCE, 5.6%. BCE's at 5.2%, but Cogeco is growing their dividend. Like, we should see at least 7% dividend growth consistently, maybe even higher than that. And their payout ratio is extremely low, below 40% of free cash flow that they're paying out. So it is a better quality dividend name than some of the bigger cap telcos, and given how cheap the share price is, it actually has a higher yield than BCE right now. So yeah, it's an attractive dividend name for investors who are looking for that in their portfolio.
Vince Valentini, good for you to join us, sir. Thank you.
Thank you.